Hello YouTubers, and welcome to the December 2nd weekend update for the independent investor. This week I did a few trades. There was some interesting activity in the market. A little bit more volatility showed up on Thursday. We saw a rotation out of the FANGs, the tech stocks, Facebook, Amazon, Google, and the likes, and actually some of it rotated into some consumer stocks, retail stocks, which have been beaten down pretty hard this year. A lot of the stocks are down 80%, maybe with the in the Christmas season now, and Black Friday kind of behind us. Some people are looking at for some value in that sector, and I'll bring up some charts a little bit later. The other sector, oil. Oil seems to still continue to be in a pretty good rally here. We see the mini light crude futures again of starting off in June. We've gone to 42 up to the $60 area. I've talked about this before. A bit of a balancing act between OPEC trying to bring some production back, and while at the same time we see the frackers increasing their production. So I don't really see oil prices really going too much higher, but in the $60 area, companies, established companies, can start making a bit of money again. And again, I've mentioned in several videos now, I think we're in the late stages of this bull market, and I'm really trying to focus on high dividend, low volatility, low beta kind of positions. And last week I did one I had owned before, and they're both limited partnerships. I usually try to put these in tax protected accounts, my Lyra for one, or self-directed RSP, because there is some tax implications. There usually is a withholding tax that you can claim. There's a form that you can try to claim to get some of those withholding taxes back. So they are a little bit more complicated from the tax side, but the dividends are quite appealing, and so I did buy some shares in, it's PSXP, and it's actually Phillips 66 Partners Limited Partnership, which is affiliated with Phillips Petroleum 66, which is actually a fairly big U.S. oil company, and it's predominantly in the pipelines, and it's had quite an attractive yield. It's 5.5%. It was kind of at the lower end of the trading range at around $45. Its dividends have increased fairly steadily over the last couple of years since the partnership was actually made. The IPO was in July 22nd, 2013. So it IPO was around 32. It did go up to quite high, actually around $80, and it's kind of been in this trading range here of 45 to about 57 or so. And it looks like the technicals might be bottoming out a little bit, and with a 5.5% dividend yield, that's pretty attractive these days, especially as I get to the junk bonds. We see more and more people trying to chase that yield, and it's getting a little bit more difficult until the Federal Reserve banks around the world hopefully bring their interest rates back up to 3% or so, which is questionable if they can do that. Their book value has been increasing at the same time, so that they've been paying the dividend out, and the book value is going up, so that's a good sign. There's a fair bit of debt, but it's been kind of tracking at twice revenues, and these are pipelines, so the cash flows are pretty consistent and steady, so they can support a little bit more debt. So again, that's Phillips 66 partnership, trades on the New York, and it's PSXP. And the other one that I've owned this one before, but just kind of repurchased, it's Magellan Midstream Partners, and the symbol for that is MMP, trading around $68. We've seen a nice kind of triple bottom here, so we find good support in the $64 area, and it has traded as high as $81. Again, it's similar. It's pipelines, oil pipelines, that type of thing, and it's kind of been around for quite a long time. Again, its book value has kind of slowly increased over the last decade or so, from about $6 per share up to about $10, and the dividend has increased from 2007 to $1.27 to this year at about $3. So we've had a very healthy dividend payout and increase over the years. Revenues have almost doubled over that time. Again, it's does have a fair amount of debt, but it's kind of tracked pretty closely with revenues, with the debt being about twice the revenues. So that seems pretty solid, and it's in the transportation, storage, distribution of hydrocarbons and related products in the U.S. Gulf Coast and Upper Midwest, and seems to be a fairly well managed company. Of course, I've got TransCanada Pipeline. I've got quite a few of the pipeline stocks, because I like their pretty steady dividends, increasing dividends, and good yield. So we did last week, I've mentioned about junk bonds now, and I did go on a short position on J&K, and then it looked like the high yield bond market did recover a little bit, but we're still seeing still a little bit more choppiness. We did see last week the price did recover back up to 36, 37, and then we did have a pretty sharp drop down there to 36.75. So there is talk of the Federal Reserve Bank. It has a new governor now, and still talking of increasing interest rates in December. So we will see how the markets take that. And I did notice quite a bit more. Thursday was an unusual day. The Dow Jones went on to make a new high, but at the same time, as I mentioned, a lot of money seemed to rotate out of the tech sector, quite noticeably. That we had a huge disparity between the Dow Jones and the Nasdaq. The Nasdaq was actually down 100 points at one point, and kind of recovered, and you could really see, the Netflix and the Amazons took were down quite a bit percentage-wise. And again, Friday, it was, again, there was a bit more volatility in that sector. I have been, as I've mentioned, I was short positions for a while now, trying to transition and building a bit of a short position up in some of these companies I think are quite expensive. And one that actually worked last week was Autodesk. It actually corrected quite a bit. Again, this is with these stocks having such high valuations. You can see here how there's they just gap down, and there's no real bids to buy the stock on bad news. You see here we went from 126 all the way down to 107 in pretty much one day, and it recovered a bit from that and closed up around 111.5 or so. So a while back I did do an outright long put on this at $130, and the put goes right out till the 1 year from this January, so 2019. You pay a little bit more for that. Of course, I bought it in the money at the time. It was trading below where the stock was trading, and I gave myself quite a bit of time for that to work. So but it did, because I paid roughly $20 for that option, and now we're down to 107. So I actually have some intrinsic value in that option, and I will keep it, because I do expect now with such a drop like that and huge volume that we could trade quite a bit lower yet. So again, we're starting to see a little bit more volatility starting to emerge in the markets now, and even last week with the VIX, which is the volatility index, we did see, which has been trading at multi-decade historical lows, and that's kind of the volatility of the options for the market as a whole. And we were down in the 9 area, and historically, 15, 20 would be somewhat normal area. But we did have a spike right up to about 14.5, and then it started to come down again. So it'll be interesting to see if this persists, if the volatility starts to increase a little bit, if the Fed puts interest rates up. I did mention we've had a bit of a flattening of a yield curve, and we'll have to see how this kind of develops in the future.